So again, it's my privilege to introduce our today's well-known speaker, a man who is very close to Nasik branch, CA Shriniwas Joshi sir. He's a senior partner in CVK and Associates and practicing over 40 years. By qualification, he is chartered accountant and company secretary since 1980. He was elected member of Central Council for the year 2013 to 16 and 2019 to 22. He was chairman of WRC of ICI for the year 2011-12. He had completed 3 terms in the regional council. While he was Central Council member at ICI, he held various responsibilities like chairman of Financial Reporting Review Board, chairman of Professional Development Committee, chairman of Corporate Law and Governance Committee, convener of Union Directorate, vice chairman, convener and deputy convener for Auditing and Assurance Standard Board, Audit Committee, Union Directorate. Currently, he was also a member of 29 committees and 3 directors of council for the year 21-22. He was member of group such as Committee for Review, Education and Training, Simplification of Companies Act, Purchase Group, Standard for Audit of Smaller and Less Complex Entity. He was convener of Revision of Publication on Mutual Fund, Accounting for Software, Audit of Life and General Insurance Company. He is speaker at various seminars of started accountants and students at WRC and its branches on subject of accounting standards, auditing standards, company law, bank audits, internal financial control, FEMA, networking and merger, UDIN, ethical standards, peer review, career counseling, how to face CA exam, etc. For the past 20 years, he is independent director on audit committee of board of L&T Mutual Fund Trustee Company, a public company, independent director on board and chairman of the audit committee of SBI Cards and Payment Limited, a public listed company, director on XBRL India of ICI, director of Accounting Research Foundation ARF of ICI. He was also president of Rotary Club of Mumbai Mulund aged for the year 2012-13. So with this brief introduction, I request CA Shriniwas Joshi sir to address the gathering. Over to you, Joshi sir.
Thank you, Sohail. Good afternoon to all. At the outset, let us thank the previous team of Shete sir and of course Rakesh ji, who and all the other members, all of you who are here now also, they were a part of the members of that group. But they did wonderfully well in this particular situation. It was very difficult to run the activities of the branch, and I think the team has done extremely well, the previous team as well, and we must congratulate them and thank them for all this. Another, of course, the congratulations is due to the new team of Sohail being chairman, Sanjeevan being secretary currently, and all other members who have got this election through and became a committee members this year. I hope that the Nasik branch will do equally well in the coming years as it was doing in the past. We all are there, all veterans of the past, where we are in the institute for more than 20-25 years. We are always with you, all of us together, to see that the branch, always does every year better than the last year. So we are all there. Anytime you want any one of us, we assure you to be there.
Yes, sir.
The branch, right? Thanks a lot. So with this, we will start with the presentation of what we want to. I'll try to share it, share the screen. I hope I'm able to do so. Wait a minute. Because, is it getting shared or no? Not yet.
Not yet.
Not yet.
Okay. Let me see why it is not getting shared. I think we have tested it also, so it should be possible to share. Yeah. Now, can you see?
Yeah. It's visible.
It's visible.
Okay, I'll just make it full screen. Okay. Now it's fine?
Yes, sir, perfectly fine.
That's fine. So let us start with it. We have about 2 hours. I hope we are able to sustain that sustain the interest in this subject, because as I was talking to the chairman and secretary, that everybody, all of us feel that when we became chartered accountants, by by birth as a chartered accountant, we know auditing, and we don't need anybody else to tell us that how auditing should be done. And standards of auditing is nothing but what we do. You always know that what is accounting standard. What is done by the business is written in the standards, is accounting standard. It is nothing new. So what is auditing standard? What we as chartered accountants do in practice in auditing it becomes a standard, because that is what the society accepts as the standards. So there should be nothing new. And all of us, including myself, we always feel what is there in the auditing standards. I started my career more than 20 years back in ICI with the bank audit and accounting standards, AS, as the speaker. Then I realized that there are too many speakers in this. Why not auditing standard? There hardly anyone who speaks on auditing standard. Let us start speaking on auditing standard and make it more interesting to those who really want to know the subject. Now, coming back to the subject, friends, when we talk of standards, why we want standards in anything that we do, accounting, auditing, or ethics? Why we need standards? It is to enhance the quality of the work we are doing. So when all of us together, go with the standards or apply the standard, the same standard, the quality of work for all of us would be on the same ground. Everyone will have the same quality. And therefore, today we will first talk on enhancing the audit quality and how the auditing standard help us in doing that, and how it helps us in doing reporting. Actually, our subject is reporting, but reporting cannot be done unless I do proper audit. So we'll have a review for first some time. We'll have a review of several standards that the institute has given us, and said that you follow them so that the audit quality will be better. And therefore, finally, remember what is reporting. Reporting is finally what we do is reflected in few pages. You may work for 3 months or you may work for 3 days. Your report is the only way of showing to the general public what we have done. They are not bothered whether you are doing work up to 12 o'clock at night or whether you have done it in 3 hours. They want to know what you want to report. And there is a big expectation gap. Obviously, we'll talk about it. But in any case, this is the only tool in our hand to show that I did a right work. So first, let us talk what is right work, what is the quality in the audit, and then how the auditing standards would help us in maintaining that quality, and what is finally the reflection of quality reporting. So report has to be qualitative, my work has to be qualitative. And if I have to see that work is qualitative, let us see how this will be helped. Friends, I always said that quality, or you have heard that quality is never an accident. If we don't read what we have to do, for example, I was talking about new Schedule 3, unless we go through the original notification on new Schedule 3 and the guidance issued by ICI, I was a part of that guidance note. As a part of CLCGC, Corporate Law Committee has issued those 3 guidance note recently, revise all the 3 guidance note on Schedule Division 1, Division 2, Division 3. I was coordinating that as a convener of all 3 groups. And that, unless you do the work like that, there will be no quality in work we do. We must involve ourselves. I had to present all the 3 divisions guidance note to the council. There were several questions which I had to answer. So I must be fully prepared on a subject that, quality will come only if we exert ourselves. It's never by accident. It never comes automatically. You will have to exert to get that quality. Auditing standard, I had to read several times before I give this lecture, so that it becomes, internalized, and then that quality will come in what we deliver. Coming to expectation gap, friends, you know that whatever way we audit, as sincerely as possible, society is never satisfied. Society feels something more should have been done by us. What should have been done? That suppose there is a fraud, once audit is done, there will be no fraud. If audit is done, there is no error. If audit is done, everything is disclosed. Nothing is, concealed from the reader. all these expectations are right in there when society thinks of it, but our auditing standards say something else. They always say that evidence comes only what is shown to us, what we have asked for. There'll be misappropriations, there'll be always frauds, there'll be several non-disclosures, or there may be, which is called material misstatements, is the technical term. There can be many material misstatements which may or may not be revealed by audit. So there is a huge gap between what is expected to deliver and what society feels we should deliver, and what we feel is what we should deliver. So what we have understood from the institute, what we should deliver, huge, and that is growing. And NFRA is just after us to see that that gap is closed or as narrow as possible. That's why NFRA. I will talk about NFRA at some other time, but that is how it comes up. Because of the expectation gap, NFRA comes through expectation gap, where frauds happen continuously in the economy. What we make a mistake, we have a conflict of interest. There is a conflict of interest discussed at MCA in several months, for several years they are discussing, and they may come out with something that audit firms cannot do accounting, is already we know. But what we are doing as individual proprietor, chartered accountant, or smaller firms, many times we are involved in accounting by the SSE. I'll call them SSE or a client. Now, if I am involved in something, preparation of something, obviously I shouldn't be auditor, or when I audit, I always feel everything is right because I have only done. So where is the question of auditing that thing again? And I will really not be an auditor, I'll be an accountant. So if I want to be a quality auditor, I should be auditor and not the accountant per se. Now, many times we prepare financial statement or compile information. Problem is that if I audit that information subsequently in the year when the case is put up or some disciplinary there, then I realize it is so easy. I miss so many things. Why I miss so many things? Because in a hurry, I prepared it for the client. If I was not a preparer, but an auditor, this type of mistake would have never happened. Because I know what is right, but I had no time because I was preparing, giving time for preparation rather, or compiling the information required rather than auditing it. Therefore, I should be a reviewer and not a preparer. What we don't do, IFC certificate, many of us would have given, Internal Financial Control certificate. Now, this certification we have done, have we really got documentation that internal controls were verified? Do we have, even whether IFC is applicable or not, because it's not applicable for all kinds of companies, have we checked really that internal controls are in place and we have a documentation on internal control? Auditing standard quality in audit will never come unless internal controls are tested. Friends, everything is computerized today, either through Excel, through Tally, ERP, or there are other ERPs in the system. Have we checked? Now, of course, the audit trail also become necessary for us to see for all changes made in the accounting system. From 22, we'll have to report that, yes, I checked that, 22, 23. Now, when I do that, whether I have carried out internal controls to see the data from which I am making my final account, or a client is making account and giving it to me for signature, whether that there is a garbage in, garbage out, have I checked the IT controls? Have I checked the manual controls? Have I checked the common controls? Both where they are. Unless I do that, I document that, I can never get a quality in audit. Friends, the other thing I like to say about quality is what Institute is doing. Institute is first issuing guidance. Accounting Standard Board gives us accounting standard, AASB gives us auditing standard, auditing assurance board. There are several other. Internal Audit Standard Board gives us internal audit standards. The Government Accounting Board gives us government accounting standard, and so many of them. Now, this is the standard, creation of a standard, and Institute wants to maintain the quality. To maintain the quality in the profession, they have several review mechanisms. One is Financial Reporting Review Board, which reviews the listed company audit accounts which are published, and without the accounting books being available, if you see, the reviewers of FRRB do such a fantastic job that even the largest of the large firms in this country have been given advisories year after year that what is wrong in the balance sheets of the listed companies. That is the quality of review we do. But there is one support to us to tell us that, what is wrong. QRB, Quality Review Board. Quality Review Board reviews a particular customer or a client, and all auditors who are joint auditors are probed, and then the quality is ensured by that. TAQRB is a new concept. Institute has formed a tax audit quality review board, which has gone into tax audit reports for the last 2 years. From this year, whatever GST reports we have signed, also they will go into it. Currently, they are only into listed companies, but that also helps us in maintaining quality. Peer review board, that they also help us in. So this is how the review is done. We are not on disciplinary. Disciplinary is the last thing that institute wants to do on its members. This is a support. You set a standard and you review that the standards are properly implemented by the profession. When we come to quality, there are a few more things done by the institute. One is we have started Center for Audit Quality. The Center for Audit Quality is at Jaipur, and they have a course on auditing standards and information technology. I hope some of you have done that. It is online course currently. You can take it. You don't have to go to Jaipur and stay. But they also have now thinking of starting. They had done one physical batch, which you can do. This will enhance the audit quality substantially. I was a deputy convener of this particular center, and that center, when I was there, we launched something called AQMM 1.0 last year. That is audit quality maturity model. This is a self-evaluation model by every firm. This is the firm level model, and we are supposed to do the self-evaluation by the firm and see how many marks I get in each of the type of that groups. And every quarter I can do this exercise myself and see whether there is an improvement is there. It is similar to DCMM, Digital Competency Maturity Model of the Institute, which has now gone to Europe. This particular maturity model tells you how much your firm is matured to do the audit of the companies or the clients who are highly computerized. What is your readiness for that? So this maintains quality in audit. If I do both, if we self-assess, both are self-evaluation models. Coming to the implementation guides, accounting auditing standard boards individually have issued implementation guide for accounting standard, auditing standard. When the implementation guide talks of the actual issues on the ground, if we can use this implementation guide, our quality of work that we do will improve, because then we will not miss on the principles of accounting or principles in auditing. Of course, guidance note, I mentioned Schedule 3 guidance notes are there. CARO 2020 guidance note is one of the finest documents. I was a part of that also, various groups in CARO 2020 and final group also, where we have created this document. And there is a group now formed by the institute to see whether any revision is required in CARO 2020 guidance note. The group will work. I'm a part of it. This will work by before March, and we hope to give some guidance if possible, if it is necessary, to change any guidance in CARO 2020 guidance note. TAQRB guidance is one of the finest guidance in quality in tax audit. If you really go by, you want to do a real good tax audit, there is a guidance note on tax audit by ICI. Now the quality in that guidance note should have been revised. This is 2015 guidance note. We are in 22, and tax is such a dynamic subject. Now, since it was not revised by various direct tax committees, Tax Audit Quality Review Board decided to review it itself. They have on their website, there is a complete questionnaire, that 3CD, and point by point, they have said in each of these items what is to be seen and how the comment is to be given if something is not found. It's one of the finest document created by ICI. I'll request all of you to go to TAQRB website, download that and use in your tax audit reports. Friends, next thing I like to tell you is about the things that today's lecture about this particular aspects that I wanted to really say. This is what institute did. This is what others did. Now this is on us. How we should maintain quality. One concept, from SA 200, that is Standards on Auditing 200, has given us one concept called professional skepticism. Now, professional skepticism and professional judgment are two terms used there, which tells us about what we should do during audit to maintain the quality. Again, I say I am linking this all to the report that we are talking. Report is the final culmination or a final result of my work. Unless I do work properly, that formats that are given in 700, SA 700, 705, 706 won't be of any use to me unless I do the work diligently. Now, therefore, professional skepticism is something very, very basic to audit and professional judgment, which SA 200 has given us the guidance on. The professional skepticism means what? It is being alert to several things. I should be alert during auditing to several things. What I should be alert to? One is that when I am looking at audit evidence, because finally my documentation is on audit evidence, and on that documentation, I write my report. Now, if I do that, the audit evidence, what I should be alert to? That any audit evidence that contradict to the audit evidence already obtained. If it contradicts to the previously obtained audit evidence this year or previous years, this is a professional skepticism. I become immediately alert that something is amiss, something is wrong. Professional skepticism means also being alert to the information that brings into question the reliability of the documents and response to the inquiries made with the management and used as evidence. So anywhere you find that the reliability of the document is in question when you are auditing, or the explanation given or responses given by management are in doubt, this is a professional skepticism. You are immediately alert. There is something wrong. Professional skepticism also means the condition when it indicates fraud. There are small errors, which if you add up, comes to a substantial figure. And there, as professional skepticism tells us that I must be alert to the aggregation of these small errors, which may indicate fraud. Now, professional skepticism also will mean the circumstances that suggest the need for additional audit procedures. That when I did the audit, I was never satisfied. I feel that something is wrong here. Then I will increase my sample size. I will change my method of checking. And therefore, that is where that professional skepticism will make me alert. Now, what it does, why professional skepticism is required? It substantially reduces the risk of giving wrong report. It reduces the risk of one. Why it reduces the risk of giving wrong report? Because the professional skepticism reduces the risk of overlooking unusual transactions, number one. Number two, it will avoid overgeneralization of the conclusions drawn. Then third is using appropriate assumptions in determining nature, extent, and nature, timing, and extent of audit procedure, and evaluating the result thereof. I'll be more alert when I do have the professional skepticism in place. What is professional judgment, friends? Professional judgment, as per SA 200, which SA 200 wants us to look at, is that it is an application of our knowledge and experience. Professional judgment is application of a chartered accountant's knowledge and experience to the fact and circumstances of the client, particularly with relating to several things. So which things I'm looking at where I apply my knowledge and experience for a particular circumstances, facts and circumstances of a client is, one is materiality. Professional judgment is required to set a materiality and use it in audit. It is required to set for deciding the nature, timing, and extent of audit procedure based on my experience, what is required. It will have to be evaluated whether I have got sufficient appropriate audit evidence. Sufficient appropriate, we will talk about when the time comes, that sufficient appropriate audit evidence, whether I have got or not, is a professional judgment before I give a opinion or a report. Now, evaluation of management judgment or appropriateness of assessing the reasonableness of estimate is done by professional judgment. I have a judgment that so many employees, so many years, what should be the gratuity liability? Now, whatever they give me, I'm not satisfied. I know the liability is half of that. What is my estimation is, means the assumptions given to the actuary are wrong. That type of professional judgment I will have, and we can think. Now, coming to the other aspects of quality is fearlessness. I should be able to not be afraid of losing the work and then compromise somewhere on the quality. Now, if there are wrong things or errors, I will fearlessly disclose. Then I will draft the audit report every year again and again. I'll never copy. Friends, copying of the last year, which is done very regularly by some of the people in our profession, is a risk. Why it is a risk is those errors or negative points reported last year may not exist today. So I am unnecessarily reporting them as wrong. Something is wrong, something is not given, some disclosure not there. Actually, they're there this year. And second is what is to be given for the current year, I'll miss it because I'm just copying from last year. So never copy, draft the audit report every time afresh, new. Another thing is we should have a clarity about what is wrong. Unless we have a clarity about what is wrong, I will not be able to give. I have another slide on that. We'll speak when it comes on. This is a very important point. Coming to the standards that we have, friends, SQC1 is called mother standard. The related essay on this of SQC1 international standard is essay 220. Essay 220 talks about the quality control and audit by the firms, same as SQC1. And essay 220 talks of first is leadership responsibility, that I'm a leader in audit as a chartered accountant or a chartered accountant audit or a partner. I must assume the risk and responsibility of the work done. I must follow all the ethical standards. It says that I should be absolutely independent, and independent is defined there. Then it says that I'm responsible for direction and supervision during audit. Very few of us do it. We tell our articles, go and do petty cash, go and do sales. Hardly any training, direction, supervision that is seen. And unless it is there, there'll be no quality. I asked one of the person who wanted transfer as an article to my firm. I said, what you are doing? He said, 11 months I'm in a concurrent audit of a bank. I said, how many times your partner comes? He says, once a month. I go there every day. I asked him whether the training has been given. He said, no training has been given. Then what concurrent audit of a bank you are expecting from a new student without any direction, supervision, training? Review of quality control is one of, then monitoring and documentation. All these aspects have been stated there in essay 220. We should read that to maintain the quality. Essay 250, friends, is a consideration of laws and regulation in the audit. There is a subsequent slide on that. We'll talk that time. Friends, when we talk of planning is a very, very important part, you are aware. Now, what planning essay 300 is talking about or telling us about is, it says that first you define the scope of your engagement. You know, your audit file should first state what is the scope of your engagement, what you are supposed to do as a statutory auditor, as an internal auditor, whatever. So scope of engagement. Then you should also list out your reporting objectives, what you are reporting, what you are trying to report on, what points, what client is expecting you to report on. So it can be legally necessary to report somewhere, or somewhere it is for you to report for becoming alert to the reader of your report. Then timelines to be observed. When I should complete the job is a planning exercise. So the standards talks of timelines. It talks of briefing the audit team on significant factors during audit. Planning requires the audit team to be aware of the significant factors. Then it talks of developing plan for nature, extent, and timing of audit procedure, how you develop a plan. And it talks of deciding the team composition, etc. And depending on the style, this nature, extent, and timing of the audit procedure, the risk involved, etc. This is essay 300. Essay 320, friends, talks of essay 320 talks of materiality. Now, friends, materiality is to be decided. As I told you, it is a professional judgment in each case, what is a materiality in audit. And unless materiality is set properly or modified during audit, the report that I write will not have the feeder, the required information from me. Unless all material errors and non-disclosures are known to me during audit, my report is not going to be good. So when materiality has a different level. One is material, what is material to the overall financial statement. You must see what is material to the overall financial statement. If that is one level of materiality. For example, if I have the total asset of 8 crore in which land is 6 crore, means it becomes material. I don't have to tell you that. And if that land is not transferred in the name of the company or the assessee or the client, whatever you call it, and that is because of some dispute that where the person who are owning the land or a relative of that, those people have disputed that in the court of law, and therefore the land is actually not transferred in your name. It is very, very important for you to say that materiality at financial statement level tells you that in a group called fixed asset, which is material to the total asset group, you have an issue there to be reported. It can be, materiality can be at transaction level. You feel, say, traveling about 10,000 is material, but petty cash expense may be about 500, maybe material. So it's a transaction level. It can be at a balance sheet level, whereas various balance sheet item, you can decide what is the materiality. This is, of course, depending on the risk of material misstatement, you will decide the materiality. And so on. I mean, you read the standard, you will know so many things. Coming to the next essay, that is audit evidence. Friends, audit evidence is something so critical to our work, because this evidence is to be subsequently documented. There is a documentation standard. Now we need to have an appropriate evidence. So essay 500 is something all of us should read before we start any critical or a crucial audit or a new audit assignment. The essay 500 talks of audit procedure to obtain audit evidence. And it says there are 5 methods, and all of you are aware that is inspection, observation, confirmation, recalculation, reperformance, and analytical procedures. These 6 things are totally, not 5, 6 things totally tell us how we collect evidence and which is appropriate for our audit. Now it also says the standard talks of completeness and reliability of the information. One is the information I get should be complete. See, friends, I'm making a balance sheet P&L. Whether all transactions of the year have been captured, I am having an accrual system where there is a matching concept, matching of income with expenditure, whether all matching, all items in matching, for example, all commission on sale is provided, all commission is provided, or any other such related things, whether whether the accounts or the record is complete. So when it talks the evidence that the completeness and reliability of the information, is the information coming from third party or from the company or the assessee or the, as you say, client himself, or from outsider, what type of quality and reliability this information has is also stated in this particular evidence standard. Sufficient and appropriate audit evidence. Here we can talk that the standard talks of sufficient appropriate audit evidence. What is sufficiency? Sufficiency is quantitative evidence. I need, suppose I want to comment negatively on an item, and I feel that if some item is wrong 10% or 20% of the universe of that particular item, I will comment. This is quantitative confirmation or an evidence that something is wrong. There is a qualitative. Appropriateness talks of qualitative evidence that something is wrong. Qualitative evidence may be that management, the person who is talking to is totally unreliable. Is a qualitative evidence that this information cannot be taken as evidence. He says something one day, something other day. So sufficiency and appropriateness of audit evidence has a quantitative and qualitative aspects. Now, relevance and reliability of information used as audit evidence is also spoken about there. It's noted there that relevance of the information that is used in audit should be relevant for me to sign the financial statement. People talk of lot of things around, but they never come to the point what I asked. Many things are not relevant. I'll be now exporting in future to USA. I'll be doing this in future. I want to have second plant. That is not relevant for today's financial statement. You see the relevance of the information you got and noted as evidence. And of course, the reliability of that is important. Corroboration of evidence, I already talked that with one with another is also important. Now, as far as related party is concerned, it's a separate standard itself. And related party, friends, related party 550 is one of the finest standard in related party transactions that we are auditing. It talks of higher risk of material misstatement in the financial statement because of such transactions with related parties, because these transactions are through complicated operations of law, complicated way. You don't know who is the owner of which organization, and they don't declare it as related party, and how the transaction is very complicated. Now the standard talks of how you identify such parties. Then when such parties and transactions are identified, what is a business rationale for that? What is arm's length price? Whether arm's length price is taken or not. And if it's not, then how to communicate? Or non-disclosures, or no authentication, or accounting standard are not followed, or non-compliance with laws, regulation, etc., etc. The standard gives you a guidance, and it's one of the finest guidance that is available there. Coming to the other auditing standard that we need to look at is one is the 315 and 330. 315 and 330, friends, talk about assessing the risk. There is 315 and 330 talks about when the risk is assessed or identified, how you respond to it is given in SA 330. So SA 315 talks of internal control environment, the risk assessment procedures of this internal control environment, information system in the organization, the design and implementation of these controls, identification and assessing risk of these controls going wrong at financial statement level, and of course the assertions at transaction level or balances level. So that is about the risk of material misstatement being identified. And SA 330 talks of various tests of controls and substantive procedure to be employed, and evaluation of adequacy of presentation and disclosure, and evaluating the sufficiency and appropriateness of audit evidence, etc. So these two standards tell us about risk and how we approach risk. SA 560 is on subsequent event, and friends, we hardly look at subsequent. We are so much engrossed in the work that is with us. We somehow try to finalize the last year's financial statement. Now still we are finalizing 21 March financial statement. We are still busy and we want still extensions. Now subsequent event are those events which provide evidence of conditions that existed on the date of financial statement. Means I have estimated, this is applicable only when I have estimated something. Debtors, recoverability of debtor is an estimation that everything will be recovered. We gave a statement also that all current assets would be recovered in the ordinary course of business. Now, when a subsequent event challenges that, for example, there is various subsequent event which tell us about or give additional evidence on the condition that existed. You have a debtor who was going bankrupt, and the bankruptcy is finally declared in June, but he was always bankrupt. These bankruptcy proceedings are going on for 1 year, and he was always bankrupt. Only court told us in June, yes, he is a bankrupt, and you will get nothing. Now that is an information which affects me, a subsequent event, and therefore a write-off is necessary, or a provision is necessary. Now these are called adjusting events, and this adjusting event are only the event which matter to me. So unless I go through all subsequent, and I'm not discussing the whole standard, but the subsequent events are extremely important, which may affect your accounts. Next is, of course, going concern. Friends, going concern is something is in my audit report of SA 700 itself. I'm certifying going concern. I'm saying directors are responsible for going concern assessment, but I'm also looking at the going concern and saying, yes, it is a going concern. Accounts are made on the going concern assumption. There are 3 assumptions on which the accounts are made: accrual, consistency, and going concern. Now, if their going concern is one of the basic assumption, then what is going concern? Going concern is nothing but continuation of operation of an organization in the foreseeable future. And when such a continuation comes in doubt, there is a question of reporting this. So reporting, even though this is not a reporting standard per se, the reporting standard SA 700 makes a mention of going concern, and therefore we need to read SA 570. Now, what are the indications that some concern is not a going concern are given there. One is, say, net current assets are negative. So current liabilities exceed current asset, or there are continuous operating losses, or there is a increasing negative net worth, or there are falling sales or revenues. Then the short-term borrowings is made to fund long-term assets. Then there is an inability to pay the debts on due dates, and you are trying to roll over, or you are trying to negotiate, and you are always in trouble of that. Then there is a loss of major market, loss of key personnel. There are several indicators given in annexure to SA 570 and it says that not a single indicator, but cumulatively several indicators will show you that a concern is not a going concern. And there is this standard is exceedingly well written. It says that client will tell you that there are several mitigating factors, in a sense that he will do something to come out of this situation, and therefore it is a going concern. So what are the mitigating factors? He will show you a cash flow for future. Say, now I will have a positive cash flow, and therefore you should accept. And therefore, how he will show the positive cash flow? He will show you liquidation of asset, a non-core asset I will liquidate. He will say there is a restructuring of debt going on with banks and financial institutions. He may say he may reduce some of the expenditure. I have decided that some of the staff will have to be, workers will have to go. They will have to, I will see that they resign. And he will say that I will delay the expenditure. That is, every 3 years, there is a overhauling of machine. I'll do it after 4 years, not 3 years. He will tell you I'll borrow more money from the market. He will say I'll raise a share capital from a strategic partner. There can be several mitigating factors, friends, but they are not acceptable to us. What we have to see is whether there are two things, whether the outcome is possible or ye khali pulao jaise Hindi mein bahut karte hain. I'm just imagining that these things will happen, or is it on the ground there is a support to the statements available. When Jet, a Big Four, resigned from a Jet collapsed 4 months thereafter. In the resignation, they said that when the liabilities or borrowings is due for repayment, the organization is unable to show us the concrete evidence that they will be able to repay this or roll it over. SBI said we are not accepting rollover. They will have to arrange for money. They were with strategic investors who said no, and auditor resigned saying either it is, in my opinion, not a going concern, and it really proved that after 4 months the operation closed down totally, and it was not a going concern. See how the assessment is done. So first is whether outcome which is stated is there is some evidence that this outcome means sale of asset or additional money borrowed, capital increase, etc. Is it happening, or it's only in effort? It's not actually happening. There is no document. And secondly, assuming this is done, whether it will improve the situation. It is not that I can't sell the asset, but I have a loss of 30 crore and my asset is only 6 crore. Selling that doesn't make a sense. It's not going to make a going concern. It's not going to help me to carry on my transaction. If that is my conclusion, then the outcome of the plan is not likely to improve situation, and I'm not. This is one of the finest standard. I've spoken on this at a length at various places, and I really enjoy doing that because it's one of a great way of explaining a basic concept in auditing. Friends, next one, if you see, is SA 505 listed for external confirmation. You all of us know external confirmations are important because the reliability of the audit, the standard says, why external confirmations? They say the reliability of the audit evidence is influenced by the source of the audit evidence, the nature of the audit evidence, and circumstances in which this audit evidence is obtained. 3 things. And if that is so, it says that the audit evidence is more reliable when it is obtained from an independent source outside the entity. So it's more reliable when it is from an outsider. It is more reliable when it is obtained directly by the auditor rather than through the management. Always written evidence is much better than oral evidence. And then the confirmations received indirectly and not received from original intended party or not from the authorized person from that party are not acceptable. This will not give an appropriate evidence. And there are so many things said about confirmation, how they are to be sent and how this is done, etc. So that is one standard we should look at. Second standard, we should look at written representation. Friends, we many times draw an MRL. All of us draw an MRL and say that MRL, once it is drawn, the owner signs, I am absolved. No. The written representation standard starts with saying written representation is necessary. They are necessary, but they do not provide sufficient appropriate audit evidence on their own. So just by getting this kind of evidence is not going to help. Now, if you really see, the standard says the nature and extent of this other audit evidence about specific assertion is still required. But the client is saying, I have signed the balance sheet. That means I have signed the notes. I have signed everything. So it is an assertion. No, they're still required. I had listed in one of the speech I was giving on SA 580, I listed 21 items where the written representation by the management is the only evidence of the entry made in the account. And you will be surprised, are there so many items in account where the management representation is the final evidence? Yes. I'll give you some of the examples. This is not a lecture on written representation, but I'll tell you. What is a slow moving stock you can identify above? What is an obsolete stock only management knows? Now you want to impair an asset, impairment of asset, AS 28. Now AS 28, sorry. There, if you want to impair, there is a cash flow made, projections made. And based on that, you decide that the current value of those projected incomes is lower than the WDV and you write off. That all projections are done by management. Now, if the investment, for example, AS 13 says, if the investment is long-term, that is held to maturity, or it is a long-term, then it need not have a comparison with the current market value. What is to be held long-term or not is a management decision. Provision for doubtful debts. Most of the time, what is doubtful is known to the management. ECL model we use in Ind-AS, but ECL model, how difficult it is to actually implement. Those who have implemented know. Provision for doubtful debt, friends, I feel is a management decision. Warranty provision. What is a warranty provision is a past data, but some for new product, there is no past data. So pure management decision on what is the provision required for warranty will have that entry made. Date on which asset is ready for use. Date on which it is ready for use. They have to say ready for use and actual use is different. And when it is ready for use, the capitalization stops as per accounting standards. Now, when it is actually put to use, the capitalization stops for income tax. Now here, when it is ready for use, it's pure internal estimate of the management. The life of an asset. Now we need a schedule 2 requires life of an asset. It can be changed by the management. Many times it is the calculation of depreciation, we rely on management. Intention to continue lease. I have a 5-year lease and I get a letter that actually there is a clause that I can increase it to 10 years myself. I mean, from the leasee side. So they say, no, we propose to hold it for 10 years. That later, the assets in that particular lease property are depreciated over 10 years. Just a letter saying that we are intent. Now there are so many examples. If I keep on saying there will be a lecture on that. I will say that this is somewhere where you need to have a written representation. There is a need, but it is not evidence on its own, but it is an evidence on its own in some of the cases. And we'll talk about this particular standard some other time. Now coming to audit documentation. Audit documentation is one of the very basic things to do before I write my report in any form. Now writing a report looks easy, but unless I have documented what I found, first is evidence standard. What is an evidence and sufficient appropriate audit evidence is obtained or not. And all these other things, what I said, have been considered. But audit documentation is what I write there. What audit documentation really helps us? Why it helps us? Most of us say that it is in my head what I did. You ask me anything about a client, I'll tell you. I don't need to document. But even the firms, larger firms have very poor documentation. I have seen in life, but a proprietor's office, last 30 years he's working. his office has exceedingly well documented files. If he makes a balance sheet and then there are changes, he has copies of all those changes with a noting, with a reason why the entry had to be changed, what is done. You will say it is a incriminating evidence sometimes, but that documentation, there's a limit of documentation that he has, but it shows us something. Friends, documentation, please don't ignore documentation. Why? One, there are 5 reasons why documentation is required. And if you listen to that without going into the whole standard, we say it evidences auditor's basis of conclusion. All of us know this document evidence, then it is documented, and that is my basis of conclusion, which I'll write in the report. Second is it evidences that audit was actually planned and performed according to standards on auditing and all applicable legal and regulatory requirements. So the documentation will prove this thing for us. Third is it will have an accountability of audit staff. When we document, when I have an audit planning done and when I execute that plan, we have an Excel sheet showing who did what. And therefore, if chartered accountants are on audit, they are responsible for what is written against them. In case of Trisure against the Ferguson, they could prove by documentation that XYZ was responsible for the mistake not being detected and not the partner on audit. It is such an important thing, accountability of work by staff. Fourth is listing matters of continuing significance for future audit. The documentation, I must write that this is what seems to be insignificant this year, but will blow up next year, and I need to look at that. Now, this year foreign travel was small, but now I have appointed various agents and various persons to go to foreign countries, and then I must look at that aspect. I have opened new products, new areas for sale, and therefore the client has done that, and I must. So there are many significant audit matters that I may have to look at in future that I will like to list. It will also, fifth is enabling conduct of external inspection and quality control reviews. When there is a review, large firms have internal review. The other branch in charge comes and reviews the file of another branch. Now there, what is best documentation? Best documentation is you don't have to explain anything. Person who is experienced in auditing will know everything, what you did, how you concluded, what was the basis of conclusion, whether your report is wrong or right. This is the right way of documentation is what is expected. Now, friends, now we are coming to something core. There are 5 standards on reporting. One is SA700, which is basic audit report. We'll talk about that in subsequent slide. Second is SA705, which is if I don't want to give a clean report, it is called modification to the report. That means there is some modification in the standard format of report I give. It is in SA705. We'll take it later. SA706 talks of emphasis of matter. What is EOM? We will talk about it there, and what is other matters also we talk. Friends, another standard should look at is key audit matters. Now, friends, it is applicable currently only to listed companies, but I feel it is one of the finest standard written on in the whole set of standard. This can be used even by us. A key audit matter. This key audit matter is a matter which is required significant audit attention. Means auditor thought that these areas were extremely significant to my audit, and those areas have higher risk of material misstatement and therefore has higher risk in my signing or the management signing something. And because there can be complicated contracts in softwares, in IT industry, there can be complicated contracts in the industry which is and other industries, and then you have to take a view what is your total revenue. And now how you account for your revenue. So there is a higher risk of material misstatement in such revenue. There can be management override of control. There can be some cases, there can be fraud in revenue recognition. Suppose in hotel, there is a cash revenue and there is a fraud in that, or certain controls are not operating effectively. And you have done something. Key audit matter is something that you will first state what was the problem, what was it, and you will write how you solved that. As an audit procedure, what you did and why you feel it is a key audit matter. So what were the significant events? What were the significant transactions according to you during audit? And as an auditor, the judgments which management has taken in various areas where estimates were made, whether those estimates were right. And if you feel that they're right, and how you check that, why you felt it was a key audit matter for you. Suppose there are 5,000 employees, see large IT companies, 1,000, 30,000 employees, 1 lakh employees, and a gratuity provision is a major item. So you say this is a key audit matter for me. That how, and then checking how you did the assumption checking for that is how you'll explain it there, and why you accepted the estimation as right is to be seen there. This is how it is. Now coming to the next is in other information. Other information, friends, is an information which is generated by the management in addition to financial statements. And SA 720 requires us to see that that information is not in contradiction with the accounts. For example, if it says that our new product launch, we have done wonderfully and our sale is reaching the sale equal to other items, and in accounts it's hardly 2%. This is what other information is, false information, you should point out, etc. SA 240, we have in subsequent slide, we will cover that when it comes to. Friends, now let us see the basic thing. I am now coming to drafting of a report. What is to be drafted? All of us know that there are standard format of drafting, draft given in SA 700, then there is a CARO report to be drafted. Now, as I say, CARO 2020, there is a complete change in the format. 3CD keeps on changing from time to time. Internal financial control, there is to be drafted by us. What is not to be drafted is financial statement and notes. And what we do, we draft that also. And I told you that we put ourselves into the shoes of accountant, and therefore all problems have. Now, while drafting the report, what is to be considered while drafting? While drafting, first I want violation of accounting standard. I'm looking at that because I say section 133 of Companies Act followed. That means all accounting standards followed. Now here, each accounting standard, some of the accounting standards are only on disclosure. For example, AS17, AS18, they are only on disclosure. But almost all accounting standards have 3 principles. Recognition principle, that the transaction is recognized as for which an entry is required to be. First, this is a transaction which should have a recording in the accounts. Second is measurement. Once it is to be recorded, what is the value at is to be recorded? First decision was this needs recording. Second decision is what is the value to be recorded. Third is what are the additional disclosures required either under accounting standard, Ind AS, or under various laws like company law, schedules, division 1 to 3, etc., or any other law like MSME laws. So disclosure is the third part. Any violation of anything of this I'm looking at while drafting. So a modified report will be required moment I find a violation of this. Second thing I'm looking at is violation of laws and regulations. Now, violations of laws and regulation can be of various laws that generally the organization is following. Several laws they can violate. The only thing what here we have to see is if that is violated, 2 things can happen. One is the financial penalty. Is the financial penalty so huge as to affect the going concern? No. Or is it that the penalty is other than financial? Suppose you can be closing a business, your license, if a pollution control act is not followed, then your organization will be closed. So again, a going concern issue. So no financial penalty, but complete closure, no going concern possibility in future. So we have to see whether a disclosure of a violation is sufficient, or you have to also consider going concern when there is a violation of law, because that is how my reporting would be done. And it is SA 250 is where we will talk on. First is violation of laws and regulation. Obviously, it is a responsibility of the management to see that laws and regulations are followed. Most of the listed companies have a quarterly report to the board that all applicable laws and regulations have been followed. This is signed by MD. This is signed by some outside firm also, which actually looks at several laws and regulation applicable to an entity and certify to the board on a quarterly basis that all are followed, and therefore all independent director feel safe when such a certificate comes, because they are only coming for meetings. Now, auditor's role to identify material misstatement in financial. Due to this non-compliance, he has to see what material misstatement can happen in the accounts because the law is not complied, and amounts or disclosure that may be affected in ability to continue. We have seen that. This is how we will look at. Now, drafting the report, we are looking at income, expenses, assets, and liabilities. Friends, each of these items can be inflated or deflated in the accounts, in the financial statement submitted to you. And I don't have to give you several examples of inflation of income necessary when there is a right issue. You are having, the IT companies are inflating income in such cases where they are having the milestone actually not reached, but providing unbilled revenue. Unbilled revenue, if you read, there is a book by the ICI IT committee. I was a convener for that group, which had that, where we have discussed about unbilled revenue and what are the risks in unbilled revenue and how we check unbilled revenue is right. I got recently a new client where the unbilled revenue was 1 year 2% and second year 7% of the total revenue of the year. I said there is a manipulation in the current year, and before I took the audit, and then he said yes, we had one figure in mind that our revenue should cross, because we had some government contracts coming if that threshold was crossed. So unbilled revenue has been jacked up to show the higher revenue in the current year. Next year we have taken a hit, and next year we have taken that unbilled revenue reversed and billing is done. Now this is how inflation of income can come. Now, even friends, even the deflation of income can come. Deflation of expense can come. For example, you want lower expense to show higher profit for certain reason. You will shift an actual liability to contingent liability. So you can discuss in each case why inflation and deflation may be necessary, but you are looking at that while drafting the report. Journal entry, friends, on income and expenses or valuation of assets and liability recorded through journal entries can be a disaster. All audit will be washed out if last 3 journal entries are seen. The result will be completely different. Just 3 entries that are made, something for gratuity provision, something for accrual liabilities, the commission which is never payable is provided just because they want to take away the money. So 8% of sale. Can you imagine 8% of sale provided by single journal entry with some letter attached to that? It changes the whole profit and loss account, tax liability, everything by just single entry of saying I must pay 8% of my sales as a commission to somebody. Journal entries are most dangerous part of checking in auditing. It's a dangerous part to look at. It is to be seen only by chartered accountants. The non routine entries. There are routine entries in some organization. On petty cash, summary is entered or a salary is a journal entry at the end of the month. After a package gives you a summary. I'm not talking of those. I'm talking of those entries which are other than routine entries, which can have a significant impact on the way I report and significant impact on the things that I find. Friend, again, SA 240. SA 240 is auditor's responsibility on the fraud. And we talked of this, how manipulation is done. And here it talks of fraudulent financial reporting and misappropriation of asset. I don't have to tell you about misappropriation of asset in SA 240 because everybody knows cash can be defalcated and assets can be taken away, and even misuse of an asset. Suppose my JCB is lying for 3 days, there is no work, but it is hired on cash. The manager gives it to someone and takes cash for that. It's also misappropriation of asset indirectly. Using the asset or using the asset for personal use is also misappropriation. But friends, what is happening today in economy is fraudulent financial reporting. Fraudulent, all including Satyam, is a fraudulent financial reporting. There is no cash fraud. There is nothing taken out of the company by the management. what is done is they have jacked up sale, they have jacked up data, they have jacked up the investments and shown that they were doing fabulously well because their profit was not taxable. And they did fabulously well and were keeping the market happy. Now, financial reporting frauds all over the world have created huge problem. You know, Enron fraud was financial reporting fraud. All the losses they parked in a partnership firm where it was a related firm, but in a partnership firm, they put all losses and all profits was taken in Enron for years together to show that it was a fraudulent financial reporting. Now there is an audit risk of material misstatement. There is a detection risk, means detection risk, and the standard says detection risk of a fraud can never be taken to zero. It can never be taken to zero. It can only be reduced. Because why? Because of the inherent limitations of audit. What are the inherent limitations of audit as per the standard? There is a use of sample. So you are never checking 100% in most of the cases. So there is an inherent limit. That is one of the inherent limitation of audit, that I'll never find all errors I can never detect. Absolute assurance versus reasonable assurance. I am not giving absolute assurance everything is right. I say it is reasonably correct. That means there are some undetected errors possible. Use of judgment. Several judgments that management makes and I try to audit can be area where there is a risk of material misstatement. Then inherent limitation of internal control system. And I don't want to discuss, you know, why there, because of the cost reason. There are several reasons where there is the internal controls are not adequate, they are old, they are not applicable to the current situation, current way of working, current way of business, and there are several limitations of internal controls. Audit evidence is persuasive rather than conclusive, and risk of not detecting material misstatement resulting by fraud is much higher than error, because fraud is always done with by a very expert person with an appropriate mind. So there are many reasons why these are inherent limitations of audit, and therefore detection risk can never go to zero. And therefore, so many disciplinaries, so many times auditor is arrested. Nowadays, you find GST for so many fraud, and because detection risk can never be zero, assuming he was very honest also, when the fraud is found, because of inherent limitation of audit, he will have to prove by documentation, which we talked, an evidence standard, SA 500, which we use and say that this is not. Now, coming to the next thing I want to talk to before we talk about 700 is, we should be, when we draft a report, we make several errors. We will go to auditing standards. We say, this is a standard report. If you don't want to draft in a standard fashion, how we do, but we make several errors because we are not sure about what is wrong. And even I'm sure I don't want to state it. I told you fearlessness. I have a fear that the client will be adversely affected. I don't want to do it. So let us talk not of that second part, but the first part. We don't know what is wrong. And we are not clearly, either we don't know or we are not clearly saying in our report what is wrong. Friends, if you really see here, you say debtors, advances and loans taken and given are subject to confirmation. What you are trying to convey? This is something in FRRB, Financial Reporting Review Board. We have said this note is useless. This gives the whole account, everything is in doubt. Are you saying under ECL model is not properly followed? Say that. If you are saying provision for doubtful debt under division 1 is not properly done, say that we need 5% provision, or the empirical evidence is there that at least 2% of amount receivable in government contracts is never received by this organization. So you need a 2% provision on all the contracts which are government contracts with so many concerns. In the empirical evidence shows at least 2% you have never got. You had a 10% margin kept there, but you receive only 8, last 2% has never been received. And therefore you want, what is wrong? Everything in debtor is not wrong. All advances given or taken are not wrong. All loans taken or given are not wrong. Not incorrectly stated, not misstated. What is subject to confirmation? Whose confirmation you want? What you want really the client to do and convince you that these figures are right in the financial statements. You state what you want. I told you several places, I need management confirmation that this figure is what is taken in financial statements. And they refuse to give me a confirmation. They refuse to give me a confirmation. Then You state that the entry has been made in investment which is taken as long term, but there is no evidence that this investment is long term, and if it is taken as short term, this will be the effect on profit and loss, because investment is today quoting at 40% of the cost, and therefore the write-off is necessary. Now you know what is wrong, you state what is wrong. Why somebody has to confirm every figure? An outsider, it is not possible, not required, then there is no audit. Another statement we always resist is stock has taken, valued and certified by management. Why it is taken? SA 501 requires us to take a stock. It requires us that this stock is taken. Use alternative audit procedures. It is given in SA 501. You use alternative audit procedures to find whether stock is right or not. If you can't go and visit, SA 501 tells us, suppose in Corona, you are not able to go out to check the stock, is given in SA 501. Valued by the management. Why it is valued? They are valuing on market value. You are not even checking, or you don't want to reveal that. So you say it is valued. What is valued? We are taking a summary figure of the stock without even a breakup of various internal items, and we are saying the value. I don't think we can write such things that just because management is certifying something, it is right, and I have assumed it to be correct, then there is no audit. I must know what is wrong. I must know that stock is physical stock does not match with the record. You say that. If you are not satisfied with valuation, say the valuation has to be at cost or NRV, whichever is lower, or at weighted average. It is on LIFO basis, and LIFO basis has overstated the value by so and so profit, whatever you want to state. Now, unless you have a clarity of what is wrong, a reporting can never be right. Okay. Now let us go to the core of our work. First is, we are now talking of forming an opinion, reporting on financial statement, SA 700, which gives us a format of the report. That particular format of the report, friends, if you have seen, it starts with several things. I'll not explain. All of us have used this format over several years. So only some of the points I'll say here. The point I want to say is that you write whether it is a standalone financial statement or a consolidated financial statement. We have found an error even in some of the listed companies being made in subsidiaries or otherwise. What is standalone versus consolidated, to whom it is to be addressed, etc. We have to state in our para that whether we have audited the financial statement of which entity, and it comprises of what. Friends, it is stated that if you see the SA 700 formats properly, it says that the financial statement include the balance sheet, the statement of profit and loss account, statement of equity, statement of cash flow, and notes to the financial statement, including the significant accounting policy and other explanatory information. We are stating it in the report without looking at and these significant accounting policies are to be given separately and notes are to be given separately. Most of the time we make the error of writing note in the significant accounting policy. Because we write what is done in the current year, you are saying that we are not following accrual basis in following 5 items. No, the policy is accrual basis of accounting. The note should say that it is not followed in so and so cases. We'll talk about that when we come to 705. That how to report that, or how to go about this accrual concept not followed. But what I'm saying is here, the significant accounting policy is an accounting policy. It is not what is done by the management against that or in favor. If it is done against and management wants to say that we are following, we say that we are saying, for example, management is saying that all accounting standard followed and the inventory policy is mentioned, or a fixed asset policy is mentioned, in a capitalization policy is mentioned in a particular way. Or it says that it follows a WW method. You want to say for some items it is following SLM method or has followed in the current year this method, then it becomes a note. The difference between a policy statement and what is actually on the ground being done is to be segregated, because in my report I am saying these two are different things, and etc. One more thing I will like to say. Of course, you are aware that we are talking of true and fair view that it gives, and I don't want to talk about that concept more. Friends, it talks of basis of opinion. Now, friends, the basis of opinion, when I am saying the base, we conducted audit, the paragraph starts with saying we conducted audit with the standards of auditing as stated under 143.10, section 143, subsection 10. That means I know how many auditing standards are in place and I have followed all of them. That is why this lecture today, that there are so many auditing standards I need to read. That is why the branch feels that we should have a lecture on this subject where the awareness is required, because we are signing that now under Companies Act 2013, that even auditing standards we have followed. And we also stay in this para that we are independent. We are independent. Independence is a state of mind, friends. Independence in ethical standard is a state of mind. And it says that I have followed all ethical requirements. Our report itself said, I don't know how many of us have read line by line the report. If we say ethical standards are followed, what is the ethical standard? Suppose I have to do a number of audits, 20 audits only of listed, or total 30 audits, or in case of tax audit, the limit is there. So whether I have followed those limits, whether I am an internal auditor, then I can't be statutory auditor, and vice versa. And this, whether is a ethical standard. Consultation fee cannot exceed the audit fee above a particular thing is given in the law. But actually doing this is unethical. You know that. Not obtaining NOC. Obtaining NOC is a following of ethical standard. So there are several things. I'm just stating that I have followed ethical standard, but what I am actually doing is a host of ethical. There will be a separate lecture on ethical. You must have heard that how many ethical standards, ethical practices are there which we need to follow, and we are writing only in one line saying I am following all ethical practices. It is such a big statement, even just in a sentence, a big statement. Then we also say that we believe that our auditor has obtained sufficient and appropriate audit evidence. Now, sufficient appropriate audit evidence is as per evidence standard. I have not read, but I say that yes, sufficiency, that is quantity, and appropriateness, that is quality of evidence, is there with me for the conclusion that I'm drawing in this particular report. We talk of emphasis of matter. We will talk it later. Key audit matters. Key audit matters is something that we talked a little on that. It is actually the most significant part of audit, as I say. The companies, then we say there is other information as per SA 720. SA 720, as I said, I told you already that there are other information given by the board of directors. In addition to the financial statement, we are stating in our report that we are not expressing our opinion to that, but we have seen that it is not inconsistent with the as per my knowledge of the client and the audit, what we have, and there is no material misstatement in that, and our report is not stating anything on other information, but at least there is no inconsistency. That is what we are stating there itself. Now there is a responsibility of management clause where it is stating several things. What are the responsibilities of the management? The clause starts with saying that directors are responsible for preparation of the account which gives true and fair view. This is a very specific statement in our audit report, and it says that company is following the generally accepted accounting standards as per section 133. If you are writing for company, it says that it is following, and there are several responsibilities of the board of directors listed in this paragraph. One responsibility is to maintain the adequate accounting records, which is for accuracy and completeness of this record. Management is responsible and takes the responsibility of accuracy of the record and completeness of the record. It also talks of safeguarding of assets. It also, paragraph talks of preventing and detecting fraud. It talks of selection of appropriate accounting policies. It talks about making judgments and estimates which are reasonable and prudent. It talks about design and implementation and maintenance of adequate internal controls which are operating effectively, and accounts are fair. And it also talks about preparing financial statements on a going concern basis, which is a responsibility of the management. So these are all the assertions done there. Of course, 570 we discussed. Now it talks about auditor's responsibility, SA 700. When it talks of auditor responsibility, it clearly states there is a reasonable assurance. Friends, there are three kinds of assurance: absolute assurance, reasonable assurance, and limited assurance. In limited assurance, that is a quarterly review, it states it is not an audit. There can never be a limited assurance. It says it is a limited review and no audit. Now, there can be only two. Absolute assurance is when you are certifying something as true and correct. Certifying something. You are saying exports realization by a company in a particular given period, realization from export was X, is true and correct. This is absolute assurance. Based on that, government will release the grants, government release the licenses, government will release other benefits that are available, export benefits to our client. So that is absolute assurance. Here we are saying in our report that we are giving only reasonable assurance that the accounts give true and fair view and there is no material misstatement. And because I have signed something and done as per the standards on auditing does not mean it will detect all frauds and errors. That is a very, very specific statement that the auditor is making. There are several other statements. I'm not going to it. What is other matter? Friends, other matter paragraph tells that what I did and what others did. I am saying that suppose I am a central auditor of a bank, I will state so many, we did all auditors together only 20 branches, or SBI auditors would do 50 branches. There are 14 auditors. So they'll do 50. So they will say, we have not audited so much of the revenue and so much of the assets. We are not audited, but it is audited by some other chartered accountant and their reports have been correctly, fully considered in my report is what is there. Then there are, of course, other legal and regulatory requirements that we all know that we are talking of CARO 2020. Now, previously we talked of CARO 16, which is under section 143, subsection 11, where additional information is to be given. We also talk about several assertions that we do at the end. We are saying that we have obtained all the information. We are saying that proper books of account have been kept, and the accounts are matching with the, they are in agreement. The accounts, financial statements are in agreement with the book. We are saying that we have seen that all accounting standards have been complied. And if they're not complied, here is the place where we will report that. We are saying that written representations have been received, that as on 31st March, no director was disqualified. I repeat, as on 31st March, not on the date of signing of the report. They were not disqualified as per the representation received, because such representations are issued on 1st of April every time. Now, respect of adequacy of internal financial controls, if the report is required, I have enclosed the report, is something that I state. And in addition, few matters have been added recently, that company has disclosed impact of pending litigation. Then company has made a provision for material foreseeable losses in derivative contracts. And the third thing is investor education and protection fund has been paid or not. So there are some of the things. I'll request all of you to be on mute, please. Hello. Please be on mute, all the participants. Yeah. So now this is called a clean report. Now let us go, and you know the urine is required, etc. I will not go into. Now let us go into modification of the report. When I feel something is wrong, some errors are there, deliberate or otherwise, management refuses to correct them, or there is a fraud, or there are some reasons why I want to state something, I modify my report. Friends, modification standard 705 talks of the form and content, means how I should report and what I should report, what I should report and how I should report when I find something, is what is stated in this standard. Now we say the auditor shall modify opinion. It says two cases where auditor shall modify, means we will not go report as per 700, but what is stated in 705 I will follow. I will follow. So that says that there are two cases. One is auditor concludes based on audit evidence that the financial statements are not free from material misstatement. Means he is of the opinion that it may be material misstated or may not be. In either of the cases, I am trying to say that this modification of report is required. And secondly, there is no evidence whether the financial statements are free from material misstatement. These two are different. First case, I have an evidence, but on the evidence, I feel that because of this evidence, it is not free from material misstatement. Second case is where I don't have any evidence, For example, stock is in Ukraine today, and I don't have any evidence. Now I don't have any evidence. I don't have any evidence. What is it? And then I accept some figure. Then I say I can conclude that they are. I'm unable to conclude rather that whether it is right or not. Suppose that figure is very, very important for my balance sheet, and then something is that critical, crucial. Is remember, SA 501 tells us that if the stock cannot be taken at the end of the year, what is the procedure to be followed as alternative audit procedure to find the stock value is right. In spite of that, if you feel that you don't have the evidence required as per SA 501 evidence standard, that I'm unable to conclude that there is no material misstatement, I will abstain from giving a report. This is what all about. Friends, this is one chart. You should make it by heart if you want to really, revise any report. Let us understand what is this. This particular is one of the finest thing done in a one pager by the institute. This is not I have not done. Institute material shows this. Now, first of all, there are three types of modification we should understand. One is a qualified opinion. Now, this modification is done for what? First of all, let's understand. It is done for non-disclosure. Something should have been disclosed, not disclosed. I am saying that say disclosure relating to AS 15 on employee benefit are not complete as required by para blah blah blah, not complete, or Ind AS so and so. The disclosures on lease property, 5-year lease, or a lease which are non-cancelable, etc. That is not given. Now that is what is non-disclosure. We have to also state what is or if it is in a figure, I should clearly state what is misstated. And then also once I say what is misstated, I should also state the amount involved. That means I must do the quantification to the extent possible. And if the quantification is, if it is possible, the effect on profit and loss and balance sheet are stated. If the quantification is not possible, the effect is not stated, but it is stated that effect is uncertain because we don't have a figure. But this is what is misstated. This say so many provisions not done. A classic case, we have done audit of MTNL, Mahanagar Telephone. You go, it's a public listed company, go on their website. There is a disclaimer report. Now you see there how many places the auditor has actually quantified and how many places the auditor is not quantified and not able to quantify. And then he says what is misstated, then he quantifies some things, some of the things unable to quantify, he states that in his qualified report. So when in case of qualified report, three types of qualification. One is qualified opinion. Friends, qualified opinion is an opinion on a particular item. A particular item is qualified, not the whole financial statements. Gratuity provision not right. Doubtful debt should have been provided at least at X value is provided at Y value. And subject to this, then the profit is overstated or understated, whatever, and the reserves are overstated, understated, etc., etc., etc. Subject to that, the accounts give true and fair. Is a qualified opinion. Qualified opinion, we are qualifying a particular transaction or a particular balance in the balance sheet. We are challenging, and we are saying that this is not right. If I know what is not right, I will quantify and give effects on P&L balance sheet figures. Otherwise, I will say it is not quantifiable, but I give subject to this, I will say that the accounts give true and fair. Friends, adverse opinion is where we say that accounts do not give true and fair. So if all provision I stated 1, 2, 3, 4 were actually made, the profit would have been a loss. Or as I gave you example of that 8% provision against the sales. Now there is no evidence that somebody needs to be paid 8% of the whole sale of the year, and they have made a provision. And I want to say that this converted a profit into loss. I will say that the accounts do not give true and fair. Do not. This is not the right kind of accounts, which I will like to say it gives. I want to say these accounts are not true. For example, I give you another example of that 8 crore balance sheet where 6 crore was land, and the land dispute is so bad, and you have read the papers and you feel this land is never going to be transferred to this particular client for next 30 years. then showing it as asset is of no use, and you feel, then you say this is not a right balance sheet. This is not. Once I did an audit of, I'll give you example of a provident fund trust. There are 12 items in the balance sheet, only 12 heads. And on all 12, we were auditing it for several years. And at time came when I was commenting for incorrectness of each of the 12 items in that balance sheet. Then I said, this is not a right balance sheet. I gave an adverse opinion saying that it does not give true and fair, because cumulatively these small errors or small thing that you see, the final picture that is there is highly incorrect. So we say adverse means it does not give. And the last is disclaimer. We discussed that in previous slide, that I do not know whether accounts give true and fair view, because as I say, stock was very important. I'm unable to check the stock valuation even as per SA 501, and therefore I came to the conclusion that stock is extremely important for this balance sheet. It may be right, it may not be right. There is no evidence on either side. I don't have evidence on either side to say whether it is right or not right. In this case, I will say disclaimer. Disclaimer is I am unable to form opinion on this particular accounts, is a disclaimer. Now here, what we are trying to do. First is we are deciding factors for various modified opinion. These modified opinions, all three types, depend on something. One is it depends on nature of matter. Now, nature of matter, with whether it is materially misstated, is relating to something. For example, appropriateness of selected accounting policy is a matter on which I want to report. Appropriateness of the accounting policy. For example, in case of company, it has to be an accrual method where it is suppose a cash method. For example, there is a cash basis for few items in accrual. Actually, we have not understood really the accrual concept. Just because some items are on cash like scrap, which is insignificant, or which is something that is not measurable, something that is known later on, and somewhere where there is, for example, the refund in sales tax was always doubtful. The sales tax officer used to say so many forms are not available. I'll add this and not give you refund. Now, always it is in doubt. So the refund was not measurable. For example, in some cases, the insurance claim, the actual amount recoverable is not measurable. Now, in such cases, I go on cash basis of accounting. Does not, for that item, does not mean my accrual is hampered, because first is significant risk and reward of ownership must be transferred in a particular case. And second is it should be measurable. That item should be measurable. And third is there should not be an unreasonable, it is not unreasonable to expect the ultimate connection. Unless all three conditions are satisfied, the item is not recorded as, say, for example, income or an expense. In that case, it is still an accrual method of accounting. We need not go. But appropriateness of selection of accounting policy per se, that, for example, in case of stock or inventory is taken at cost. No, either the inventory is current or stock has to be at cost or market NRV, net realizable value, or investments have to be at cost or market value. So if that no appropriate accounting policy is selected, then that is the nature of the matter on which I want to give a qualified opinion. Another nature of the matter can be application of the accounting policy was right, but its application was wrong. As I say, accounting policy stated lower of cost or NRV, but actual practice, I have not used that. I told you the difference between accounting policy and what the company has done will come in notes. And if the company say this year, company has decided to follow market value for valuation of stock, is something that application of a selected accounting policy is incorrect, and you will say, no, this is not right. Another thing about nature of matter, I will like to give a modified opinion, will be appropriateness or adequacy of disclosure. For example, if you go to AS 18 on related party transaction, it talks of three things. One is identification of a related party. So if it is not properly identified, this is a matter of concern, I will report on. Second is the transactions with related parties, balance with related parties. If that is not properly stated, I would like to comment. And materiality. Materiality, suppose, is not properly, there are some material items not properly disclosed or adequately disclosed. going concern is not properly considered, etc. All this will come a nature of the matter on which I'm giving a modified opinion. It can be either of the three, once you know. Now, second, you should know about inability to obtain sufficient and appropriate audit evidence. When this will happen, first you should understand, and then we go to actually, going to the modified opinion. Now, suppose inability to obtain sufficient information can be because of the circumstances beyond the control of the entity. For example, the stock is lying in Ukraine. I told you, today it is impossible to know what is the correct stock. Or there is a strike in the organization and no physical count could be taken by the management itself. Or, for example, in COVID, the companies were closed, especially in March, April, May, and we had no way of entering those areas and actually taking a stock. So circumstances can be beyond the management, control of the management. For example, accounting records were destroyed in Konkan area due to flood in Chiprut. Now, these kind of things that happen, or sometimes there is a raid and the hard disk or even the physical records are seized by the authorities and not immediately available. Now, all this indicate the circumstances beyond the control of the entity, and therefore you may not have the sufficient appropriate audit evidence for you to give a report, and therefore that can happen. No appropriate evidence. Another area where it can happen is circumstances are in such a nature. For example, timing of testing. Now, IFC requires you to test the control throughout the year. Now, you are saying at the end of the year, you should have a cash count, or you should have a confirmation method, or you should have the stock need to be checked. Various internal controls need to be effective and need to be checked throughout the year, end of the year. But you are appointed in July for last year. Now you, as a tax auditor, say you are appointed in January this year, 22, and you are supposed to do it by a particular date, and that is for March 21. No control can be tested. No control can be tested. This is where there is no appropriate evidence that everything was right at that point of time, even though I have guidance how to check it. Third can be when it is inability to obtain a sufficient evidence, can be where it is a limitation imposed by the management. Management says, there are reports enlisted also that you don't go to so-and-so country, you don't go to so-and-so branch. We are preventing you from doing this. This is where there is a limitation by management. Of course, there is a procedure given in 705 that you go to those charged with governance, ask them that I need this info, and nothing happens. Just give a report which is saying that no, financial statements do not give. I don't know whether it gives a right report. So I'm unable to obtain any information because you are preventing. The management is imposing some limitation on you, and therefore it is not possible to do so. So in such cases, naturally, you will say that I'm unable to obtain sufficient appropriate audit evidence. So these are the three examples of that. Now, auditor has to decide whether a particular evidence has to judge whether a particular evidence is all pervasive or it is not all pervasive. Means pervasive effect can be undetected due to inability to operate sufficient and appropriate audit evidence. Now, if my observation is not confined to a specific element, or whenever it is confined to a specific element, and it represents substantial portion of balance sheet or P&L, and it is necessary for the reader to understand it, that the whole balance sheet is, whether it is giving true and fair view or not. So all this can have either I don't have any information on that, or the pervasiveness of the matter is something that I have checked. Then in that case, obviously, I will report in a particular way. See the right hand side. Now we have seen when financial statements are materially misstated, I have come to a conclusion that it is not all pervasive. Means that particular mistake is not pervasive. It is limited to a particular type of account, type of balance, type of transaction. Then I'll give a qualified opinion. But if the matter I give you again, I go back to the example of land, it is all pervasive, then I will say adverse opinion. This does not give a true and fair view. Financial statement are materially misstated, and material misstatement is all pervasive. In that case, I will give adverse opinion, means the accounts do not give true and fair view. When there is inability to obtain sufficient and appropriate audit evidence, but it is not all pervasive, means I don't have an evidence on a particular item. On a particular item, I don't have an evidence in the profit and loss balance sheet, or in the asset liability, etc. I mean profit loss asset liability. Now I mean expenditure income asset liability. It is not all pervasive, but on a particular item, then I'll give a qualified opinion that so and so information is not available to me and I'm unable to report. For example, you don't have the actual valuation report. Then you will say, I am unable to say whether gratuity liability is right or not. Or you are unable to get some of the contracts the company is not showing you. So we will state that they are not showing us some of the contracts. Because of that, I'm qualifying an opinion on a particular item in profit and loss balance sheet. But when it becomes all pervasive, that most of the information I wanted is not available. I got one chartered accountants came to me and showed me the balance sheet. I showed him, told him, you immediately please resign. This is a Ponzi scheme. He said, yes, this is a Ponzi scheme, I know. But they are not giving me any information on any item. How commissions are being given, what are the contracts, how much is the future liability, nothing. Then I said it is all pervasive. So we disclaimed the opinion. I gave him how to disclaim the opinion in that particular case. I told him that the directors would go to jail. They did go to jail. He could have been also jailed. He was called by ED and others, and he could prove that in disclaimer of opinion, he has very clearly stated that nothing, there is no supporting evidence for so many things in profit loss account balance sheet, and he was saved. He was saved because of the way he reported, and he was never jailed. Otherwise, he would have also been jailed. You see how important it is for you to see that when you have to disclaim an opinion, when you have to give a complete adverse opinion saying that no, this does not give true and fair. You do it fearlessly, friends. It is a very difficult period, especially for larger clients. We can be caught on wrong foot when there is a dispute in client, directors, partners. They will punish us. Actually, they are punishing us because they want to punish the other side, which they cannot. And therefore, they punish us. And we are honestly caught between the crossfire. And here, this particular standard will save us, SA 705, from all sorts of issues that we might get. Now, there are two more things that the reporting standard talk about, and we'll talk and close this. One is emphasis of matter, and one is other matter. Now, friends, 706 deals with, first is with the additional communication in the auditor's report. Now, what emphasis of matter talks about is, we want to draw either of these, EOM and OM, other matter, is saying that in addition to whatever I communicate in the standard report, now this we are not talking of a modified report. Modification of 3 types come in SA 705. Here, I am only drawing attention of the reader to some of the extremely important matters. Now, for example, if we talk of emphasis of matter, now that matter has been properly presented or disclosed in the financial statement. Remember, if it is not so presented or disclosed appropriately, I will go to 705 and report. I will modify my report. First thing for EOM, emphasis of matter, is the matter should be appropriately presented and disclosed in the financial statement. But in the opinion or a judgment of the auditor, it is of such an importance that it is fundamental to the user's understanding of the financial statement. Now here you understand that why auditor feels that note number 38B is important for you to read. You don't want in a large statement, a large financial statement with other information as given by a listed company, huge reports. He is drawing your attention to a note which is so much. I mean, they have started giving note, right, starting from the share capital and end on the last item on the asset side. And it goes into pages and pages and pages. He is drawing your attention because he feels that that particular thing is very, very important. Now there are several examples, of course, can be given. For example, if it says that there is a dispute with excise or income tax or GST, if it is taken as a contingent liability, okay, because of the legal opinion. Now you have accepted a legal opinion, or you also knows the case laws where the case can be won. Case has gone as high as in tribunal or in high court, but you feel still there is a chance that the SSC will win this particular case. So it is appropriately taken as a contingent liability. So first thing is satisfied. Appropriately presented and disclosed as contingent liability with all the note given there. How it is, how about that? What I feel that if all our calculations, suppose I am depending on a particular high court case of a particular state, and you know, our state can give some other opinion. It can always have some other decision. And if that particular thing is whatever, I accept something, client accepts something, both have accepted legal opinion. But if it goes wrong, then what can happen is there can be a substantial effect on the balance sheet, financial position of a company. I know of a note which stated that there is an excise demand of 300 crores on a company having reserve of 1200 crores. Now, if the demand, you feel that demand is not right and you will win, etc., etc. Now, if the demand you lose that particular case, first of all, your cash flow will be totally gone out, and secondly, you will lose 25% of your reserves. Now, this is a very substantial matter, and I will like an AOM para on that. And this particular standard also tells us how to write an AOM para, gives various examples. There are various articles in the journal, CA journal, to say how this is done. But actually, you can have many other examples of UM when the financial reporting framework is unacceptable. It is done in a, for example, the other than company I'm talking about, they are on cash basis. You know, as early as in 2004, Institute of Chartered Accountant gave you a para that these accounts are made on cash basis. Actually, the basic accounting assumption is accrual, but these accounts are on cash. And why they are on true and why they are true and fair, the para states, and therefore that becomes an UM. So unacceptability of a framework. You can have an UM saying that it gives true and fair view in the cash system of accounting, the way it is followed. And the note says what is cash system of accounting, what is cash system against the accrual. Now saying that amendment, now there are some subsequent events, and subsequent event required the the accounts to be amended. For example, in case of Satyam, the accounts were rewritten under the code guidance and the current, those days, board of directors guidance and all, before the company was sold to Mahindra. Now, this particular case, the auditor would say that this is an amended report due to some subsequent event of fraud being found and the accounts being recasted. And therefore, I'm drawing your attention that this has been restated on these lines. For example, you can have exceptional litigation. I told you there can be exceptional regulatory action against the company, and that is shown in the notes, but you want to draw your attention of the management, of the reader, etc., is another example. Another major catastrophe also can be where it has a significant effect on the current year or subsequent years. You can, catastrophe I'm talking about, can have a substantial effect on the sales. Suppose a catastrophe in a particular region will affect my sales not this year but many years to come or few years to come. That is shown by the management. These uncertainties have been properly disclosed. I am just drawing attention. That is EOM. Another thing I like to tell you of EOM is not a substitute for modified opinion. This is an escape route. Our profession within four walls, I can always tell you, this is an escape route used by our profession to give EOM instead of modified opinion. That is a qualified opinion or adverse opinion. I have not used that. I say that management says this, that the stock, I go with stock as taken, valued and certified by management, and I give it an EOM. That will not absolve me of the responsibility. If I feel stock valuation is incorrect, I must go to SA705 and report. EOM is not a substitute for modified opinion. Of course, it can't be CAM, and a subsequent event I have already explained to you. Now let us go to other matter as the last item. A matter that other than those presented or disclosed in financial statement that are relevant to the user's understanding of the audit, that it is and the auditor's responsibility or auditor's report. Now these are, first of all, remember that these matters, other matters, are matters which give the further explanation to auditor's responsibility. For example, first time the tax audit was done, first time, there was no tax audit in the past, and opening balances you have accepted. There is an auditing standard, there is a guidance also available on opening balances. Guidance. Now, opening balances, when I accepted, the guidance is there, how I check opening balances. And even then, I will like to say that opening balances have been taken from the previous balance sheet, and they have been accepted by us as right, subject to our various auditing procedures that we followed. But I am drawing your attention that they have been taken from the previous year. You have to also state, when you are stating this, that such a matter is not required to be stated or presented in financial statement. I am telling you something additional. Management has not said this, that opening balances are taken from unaudited account, but they are not required to state that. I must also state, when I say other matters, that I am telling you this has nothing to do with the any legal requirement, and management has not missed something. I am giving you something additional. And one thing, therefore, remember, what needs to be given by the management cannot be OM, other matter. Something that is required to be disclosed by legally, by otherwise, by standards, the disclosure standards, disclosure requirements under various standards, that cannot be done by auditor. If they are not doing it, you will not do it in other matter. You will just go to 705 and comment. You will not give it. This has to be, this cannot include an information or a matter that is required to be provided or to be given by the management, and not, it is not auditor's responsibility to give it in OM. It is not, cannot be done. Of course, giving such a thing should not be prohibited by law. Sometimes it may be that you cannot disclose, for example, the provisions made by a bank on bad loans. If the law says that it should not be given, it should not be done. That cannot be other matter. It is not required to be done by management. It satisfies that condition. But the law requires you not to disclose, suppose something, then it cannot be done. The matter has not been determined as scam. That's okay. That's a way of saying. And auditor expects to include EOM or OM. Those charged with governance need to be informed that I'll be doing OM or EOM. Now, CAM or OM, there is a CAM or EOM, there is a difference. People were confused. Currently, there were notes in every listed company accounts or other accounts giving a note on COVID, which institute had given to us, how to write a note on COVID, or how to write a note on remote audit being done by us. So we all followed that. Now there is a difference between the two. I will draw attention to that if there is nothing to be reported. In a sense, a normal thing. For example, you are trying to draw attention to the management saying everything is uncertain. Everything is uncertain. Share market is, I am in the market. I am a market operator. My income depends on market of people buying and selling securities. And there is everything is uncertain. People are today not buying or selling anything because everything is so uncertain. My business is uncertain. This is a no. So you are making the reader know that future is highly uncertain, but it is properly taken care of. Management will say what are the things that they did. Hello, please be on mute. Please be on mute. So management will... Hello. So management is telling you that the future is uncertain, but it is properly recorded. Now that is clear. But sometimes it is a CAM. What is a CAM? That management has said, given some estimate or judgment. I told you in IT companies or in logistic companies, you have very complicated contracts, and management has gone into this particular aspect and had some assumptions done, and they have disclosed the assumptions. Now we have estimated income based on that whole methodology, that the various models that management implemented and did. Here it is CAM. CAM is something where there was an audit issue I identified an audit issue, I approached it in a particular way and disclosed that. That is CAM. EOM is not a CAM. EOM is not about how I did audit, what procedure I followed, what is the conclusion I did, why I accepted management's figures, etc. EOM is purely drawing attention to something. I told you uncertainty. You have accepted uncertainty. You have taken appropriate provision, risk, responsibilities is properly covered. Now, in that case, it will be EOM. Please distinguish what you are doing. In other matter is not legally required to be disclosed. So you state that I am giving it as additional information to you, etc. And this is not required. So with this, thank you very much for a very patient listening of this particular thing. I think almost everybody is continuing as up to the end of the lecture, and I feel that that itself shows that you were interested probably in what I was sharing. Thank you very much. I hand over back to the chairman of the branch. Hello. Hello, are you there? Hello.
Yes, sir.
Yeah.
Yeah, it was really a privilege to listen you. And as the entire Nasik branch knows you very well and are always eager to hear you, because the Nasik branch understand you so very well. Just I'll request the chairman to pass any remarks, and then we will go for the vote of thanks.
Basically, I just want to share one thing is that tomorrow we are having interactive meet with Minister of State Finance, Bhagwat Karad sir. So I request everyone to join for this meeting. It is at 3 p.m. ICI Bhavan Ashoka Marg. Also, it was a really interactive session, sir. So we really enjoyed this session, and we will see you soon in person at Nashik branch for bank branch audit session. So I will, sir, coordinate with you for the same. Over to you, Abhijit, sir.
Yes, thank you, Sohil sir. I now declare a vote of thanks to our beloved Shriniwas Joshi sir. Sir, it's always an honor to listen to you, because the way you explain and the way you consider issues related to a small city like Nasik is really commendable, and it always helps us to conduct our audit properly and give proper disclosures and consider all the standards. So I again thank you, and as we know that we will always be eager to hear you, and now obviously physically, as now we will be starting with our physical lectures in the Nasik branch. So we eagerly await for you, sir.
Thank you. Thanks a lot. Thank you all for being here. Thank you for the branch for inviting me for this video lecture. We have done it in the past also, but there was a big gap. Good that you thought of it. Let us continue to be associated for a long time. Thank you very much.
Thanks a lot, sir.
Thank you all. Thank you. Thank you, Chairman.
Thank you, sir. Thank you.
Yes. Let us have a scintillating performance in the whole year as a Nashik branch chairman. I know you will do it. You are capable.
Yes, sir.
You and your whole team.
And with your support, definitely I will achieve it.
You and your whole team is very good. So I hope everybody joins you in doing the work that you need to do. We are there.
Yes, sir.
Thank you, Abhijit. Thank you, Sohilji, and our secretary also. So thanks a lot, all of you.
Thank you.
Great. I'll disconnect, right?
Yes,
Yes.
sir.
Thank you.
GST 18,000. 6,000.